Hi, everyone. Thank you for joining WisdomTree's office hours on the Fed marches into Q2 on hold, where you will hear from Professor Jeremy Siegel, WisdomTree Senior Economist, Jeremy Schwartz, our Global Chief Investment Officer, and Kevin Flanagan, our Head of Fixed Income Strategy.
Thanks, Irene and Professor. It's always great to be with you. I'm sure you're even more excited when you see a lot of green on the screen and new highs in the S&P. We've been talking about broader participation in the rally. We see that a little bit today with the comments from Powell, but always great to get the professor's reaction on what he sees, what he expects, and what we're going to see going forward. So, Professor, I'll kick it to you to share your thoughts.
Thank you, Jeremy. This was more dovish than I thought it was. I gave a little warning this morning. I thought the dot plots were going to show one. It did show. Two cuts. It did show three by the skin of your teeth. There were 9 that were at 3 or in 1 or more, and there were 8 that were 2 or less. But it seemed like if one person changed their opinion, that would have changed the headline. They definitely moved up 2025, and they're, for the first time in years and years, they're moving up their long run. Now, we've talked about this for a long time. R star, the real rate at equilibrium is not 0.5% anymore. I don't even think it's, 3/4. I think it's 1.5 at least, which would really make the long run 3.5. The history of the Fed is way too slow at moving that. They moved it down way too slowly, over the years, from 4.5 down to 2.5, and now they're going to move it up also too slowly. But that's one reason why I think, basically the long bond at 427 right now is exactly where it was at 159 1 minute before the Fed announcement. It just didn't move. Now 2 years moved down, of course, because there was fear that there was going to be a more aggressive Fed. Really, he's totally balanced now. I liked, and this is really good for stocks, his statement is that, any unexpected weakness in the labor market is reason to lower. This is saying, I'm looking at that too, as I should. It's my dual mandate. Like I've got inflation. It's not where I want it, but it's low enough that if I see weakness in the labor market, I'm going to lower. This is very positive, clearly for equities going forward. Also, by the way, he mentioned none of our indicators show weakness in the labor market, and in fact, he explicitly mentioned unemployment claims, which is, of course, a number that we've been talking about all the time, that I look at very closely, and it's also showing absolutely no weakness in the labor market. I was a little disappointed. He talked about wages not being a problem, but he didn't talk about one of the reasons wages is in the problem is because productivity is high. I thought he should throw that in because it is high, and that's one reason why you can have lower wages, lower inflation even with the wages at 4% or so. Another thing he mentioned, this has been a theme that we've been talking about for months, if not years. He said, rent will eventually get into our CPI to push it down by the second half of the year. We don't know when, he said. I don't know when it's sort of like we don't know when those crazy statisticians at the BLS are finally going to do something right here and get that rent in there, right? But you know that Jeremy and I have been doing a real rent index. We show year over year under 2% if you use real rent indexes and rather than the BLS rent indexes. He seemed to nod his head saying, I don't know when that's going to kick in, but that's going to be a downward move. On the other side, there are 2 things to watch, and these are not bearish for stocks, but there's something to watch. The downward movement of sensitive commodity prices is over. The Bloomberg and the other indexes have broken their downtrends. I'm not saying they're starting an uptrend, but that big downward movement that we've seen over the last 12 to 18 months is over, with sensitive commodities up and down. And I don't just mean oil, which although down today has has definitely been on the firm side. So, we definitely see that. Something else which I've been encouraged at. Now, we don't get, the M2 money supply, and it's lagged until the fourth Tuesday of the month, but I follow weekly deposits at banks. It has been rising. Now, it's only, 1% above a year ago, but it had been totally stagnant. And over the last 5 to 6 weeks, I've actually seen some increases. That comes out Tuesday at 1 o'clock for those of you who want to check out that data. That's encouraging. That's a major part of that money supply. We want that to grow at a reasonable rate. We may not need it to grow at 5.5 because of substitutes that such as our USFR that can be used that are not counted in the M2 money supply but should be, since money market mutual funds are. But nonetheless, that is growing again. So we're not getting pressure from that. Another very positive thing that should be mentioned. He does not want a repeat of 2018-19 when they were lowering quantitative tightening, lowering reserves, and suddenly the bank said, "Ouch!" And there was a little bit of disturbance, chaos in the Fed funds commercial paper market as a result of that. And he said, "We're going to lower the rate." Now, not ready to say when. Is it June or September? I think they're going to probably lower it to maybe 40 to 50 billion a month rather than the 95 billion that they have today. But that's a cautionary. I'm not. We don't know how much is just enough for the banks. We obviously we underestimated that number 5 years ago, and we pinched them. So we want to approach this quantitative tightening slowly. Now, I've been one of these that say, don't get overexcited about that, but it's good that they are cognizant of it and don't want a repeat of 2019. So, basically, from what I can see, all the right words are coming. Not overly anxious, just like he wasn't overly encouraged about the inflation coming down last year and saying, to stampede him to lowering rates. I'm not overly anxious about two numbers that are slightly higher than anticipated going into that. And that basically seems to be the message. The next meeting is May 1st. Of course, we have another cycle of CPIs, PPIs to go through and see if there's any really weakness in the labor market going forward. There's also been more talk, as you all know, about the strength in the labor market probably coming from immigrants, that boosting immigrants, boosting that labor supply. But from what I could see, this is a green light for stocks. Now they're fully valued, so it isn't like we're going from an undervalued position to shooting up. But nonetheless, this is a green light for stocks. The economy is still moving. GDP this quarter that's ending looks like it's going to be around 2%. JP Morgan, Goldman's over at high ones. I believe that Atlanta's at low 2, so they're very close. It looks like a 2% quarter. And that was a big jump, as we know. The estimate is that GDP this for 2024 is actually going to be 2.1. This was 1.4. I mean, I'll have to go back on my records. To have a 70 basis point jump in a yearly GDP growth number over a 3-month period, I don't remember seeing it that high. Now, one has to realize, if my memory serves me, in December of 2022, they were forecasting 0.9% GDP for 2023, way underestimated. And they started this year by underestimating it also. But they've jumped it up to a number now that certainly is virtually what the number looks like in the first quarter of this year. Kevin, what is your reaction here?
Well, Professor, I wanted to ask you a question. So, when we've been doing these for a while now, and the expectation was March was going to be, let's call it, even though it's cutting rates, lift off. That's a moot point now. I think we can all agree to. And now June is sort of like the new time frame for when the rate cuts are going to begin. But we've been talking in our investment committee that maybe let's not get bogged down with when the cuts begin, but what are they going to look like? What is this episode of rate cuts going to look like? And a couple of weeks ago, Vice Chair Jefferson was talking about 1995 as being a parallel when they began cutting rates after raising rates 300 basis points in 94. They then started cutting rates in July of 95, then December of 95, and one more time, I think, in January 96. And that was it. Should we take any lessons from 95 into what we're going to see now?
Kevin, I think it's very dangerous. People say, they point to one historical, there are so many things different, about the economy today than we're talking. 95 is 30 years ago. And I remember it, but I would really be reluctant to take any parallels. I mean, this is recovery from COVID, which of course, we didn't have an epidemic for 100 years. There's something when we didn't have a money explosion like this ever before, and then a money contraction. So there are things that are going on that are just so out of historical, precedent that when people, bring me back to one, I kind of shrug my shoulders more than anything else. I think it's really dangerous. I think it also, and people hang on these estimates of these FOMC, participants, and the truth of the matter is, they're not really forecasters. They're not better than any other forecasters. Maybe not even as good as the average private forecasters. Do they really know? No, they're just, they say, I'll wait until the data comes through and I nudge, one way or the other. If it's a little hotter, we'll hold. If it's a little, cooler, maybe that's the time to go down. I mean, if since we only get, we only have really 1 month until the May meeting, and the month of April, could we get weakness that's that much? I did mention that even though 4% is their, in fact, their unemployment target for the end of this year, as I'm looking at it, is 4.0. I mean, that 4.0 would grab some headlines. I mean, it's a political year. Obviously, the Republicans will say, my God, it's the highest in 2.5 years. It's moving in the wrong direction. Would there be, pressure on the Fed? The Fed is supposed to be independent, but it is a political animal. It's going to be as independent as it can be. Right now, Chairman Powell is grinning ear to ear. Listen, this could not have been a better scenario. Remember how many mainstream economists, unfortunately not me included, although ones I respect, that said it was absolutely impossible to reduce inflation without substantially increasing the unemployment rate. And I said, looks very different from me for a number of reasons. Could happen. I didn't say it would, but it could. So, they're grinning in their ear. So, they're really not on the hot seat as they were for so many months when they were so delayed in terms of rising inflation. They're really sort of happy. If the economy continues to chug at a 5.3 Fed funds rate with no slowdown, and as long as commodity prices have stabilized and deposits seem to be on a slightly rising trend, you can really ask your questions. Do they really need to cut? And by the way, I said I thought 4.5% was a long run 10-year, and I still say that. But if I would say what are the risks on that, I would say the risks are on the upside.
So just to follow up
on that, if there are risks on the upside. I mean, what are we now on the 10-year? 427. Yeah.
So I just wanted to follow up on that because it goes right into one of the questions we've got, and something Powell said at the Humphrey Hawkins testimony last week, that the Fed doesn't necessarily have to wait for inflation to get down to its 2% target. So let's
That's
just
correct.
say, for argument's sake, it gets to 2.5, and they're itching to go. Is that a potential policy mistake? Do they reignite inflation if they cut rates?
No, I don't see it. Certainly, no. As I say, I keep, what do I look at? Sensitive commodities outside of oil, although oil is a factor, but often you have to understand it has some unique supply characteristics. I look at those weekly unemployment claims. I look at that weekly deposits and liquidity that's provided by the banks. You could also look at spreads between junk bonds and triple A's, and you can look at financial conditions index. These are really sensitive indices that would indicate some sort of tightness in there, or anything like that. And I don't see them. All I am saying is, commodity prices stop going down, and deposits are, thank goodness, rising modestly again. That's not inflationary, but it is no longer deflationary. Now, one should also say about the housing that is held up so well, we had really strong housing starts. Builders are buying down those mortgages. They're buying them down to 5%, which means they're putting it into price, right? And whatever that cost is, I haven't calculated what 10% of whatever the mortgage is or whatever. They're just adding it to the price. And then, everyone thinks, well, home prices go up 5-7% a year always. It doesn't matter. People don't understand it. Well, it matters where you're starting from. But they're selling homes as a result of that. But they're buying down those mortgages over there. The real true, right now, the no point 30-year mortgages are over 7%. 7 to 7.5, no points. That's pretty stiff at today's prices. So I'm wondering how long housing can stand on that. But let me go back to Kevin. Let's put it this way. If inflation, continues to go down by their measures, even if real activity stays where it is, 2% real GDP, unemployment claims within the range, et cetera, and so on, they should lower rates on that, because Powell has repeated that the fact is they don't think the real rate should be this high. Now, I think the real rate is higher than they think, but not this high. And so they would be lowering rates just to keep the real rate from getting higher at that point. That would be the most beautiful spot of all, is to keep the economy chugging and the unemployment rate, the inflation rate to keep on going down, and then the lower rates as a result to an absolute smoothest landing that you can't even feel the bump on the runway. But right now, nothing disturbs the scenario that we have been offering here. I think the stock market's in a strong uptrend. I guess there are momentum players. There always are momentum players. I cannot answer the question whether this is the beginning of is this a 96, 97 beginning of the bubble? It's way too early to tell whether this is now. NVIDIA at 35 times forward earnings is certainly not expensive. But those bubbles can form at any time, in any market.
Yeah, I was going to go with a related question, because coming into the year, we talked about broader participation, and today's market moves. You saw small caps outperforming. Is that part of the thesis too, that hey, the Fed is now showing their flexibility, lowers the probability? When you talked about the S&P at fair value, small caps at 12 to 13 times earnings in many places are definitely not their normal value.
No, they're not. I mean, I would have to look at each of the you know better than I, Jeremy, about the weightings on each sector. I mean, what is the tech rate? What is the tech percentage on the Russell 2000?
Much smaller than large caps. So
Yeah, much smaller.
it's much more.
And of course, and the financials much larger, right? And they're smaller financials. They're not the J.P. Morgans. And they're obviously. I mean, listen, the commercial real estate is going to keep those depressed for a long time. Now, as long as listen, we've talked about this. If that firm is paying a dividend and is not going under, in other words, you'll do well by holding it at a depressed price. But I don't think the pressure is off on commercial real estate. I'm not saying it's increasing, but that New York Community Bank would still, after supposedly not knowing, a lot of banks are looking the other way on what they are now. I think investors are not. I mean, some people think investors are still being fooled. I'm not so sure they are, but it's a lemons problem. I don't know whether you're fooled or not, so I have to price you very carefully. Now, as far as other small firms are concerned, yeah, I mean, the infrastructure spending that's taken place, the fact that interest rates will eventually go down, but I think right now, I mean, what is prime rate? Well, prime rate's usually 300 basis points above the Fed funds. So that's about 8, right? I mean, I don't know what if small firms are borrowing prime, or maybe there are what SOFR and not LIBOR. It used to be LIBOR, SOFR plus 1.2 if they got really good credit ratings and they're on a floating basis. So they're still 6 to 7. Now that's much higher than inflation. You've got to have a good profit margin if you've got a lot of rolling short-term debt. I mean, it's so much different. When interest rates were basically zero and inflation was, 3-4%, so your inventory was going up, and now compared to now, when that has reversed.
John just wrote in a nice question that I think goes to some of the things you talk about all the time, and some of the misinformation that I think is out there. Like one of the notable strategists put out that the equity premium is at all-time lows with the treasury yield versus the earnings yield. But John's question was, you mentioned it's fully valued, but still have the green light. Can you talk about your long-term return expectations from here? So maybe you could give them a view.
Right. I mean, first of all, I mean, you're dealing with real versus nominal. You're dealing also with what's a risk of inflation going forward, which you hold with bonds. So you hold bonds at 5.5%. Let's say, well, you can't get let's say you can get probably long-term corporates at 5.5, and 5%. Let's say is the real yield. That's on stocks. That's a nominal yield on bonds. I mean, so right now, the 10-year TIPS is 1.94. So let's say that's 2%. 20 PE is 5%. That's a 3% equity premium. Now, yeah, that's a little smaller than historically, but two things have to be, the long run stocks is 6.8 and the long run bonds is 3.5. That's a 3.3. That's a 220-year average. So right now we're at 3.0. It's some people are sort of talking as if this is like 5 standard deviations below where it normally is. No, it isn't. And you always are comparing apples with oranges here. So right now we have a 3% premium. Also, the fact, as we've talked about, I mean, are inflationary episodes more likely in our future now than we thought pre-pandemic? Well, given the deficits and everything else, the answer has to be yes. And if that is a risk factor, for bonds that is not in stocks, then obviously that is something that would lower the ostensible premium, but not lower the attractiveness of equities versus fixed income.
Professor, do you have any concerns about the level of consumer or household debt where we are now and the debt servicing costs?
No, because the level of assets is an all-time high. I mean, I don't have exactly what those ratios are, but never has there been more home equity, ever. Two-thirds of Americans own their own home, ever. Stock markets are at all-time highs. The two sources of wealth. Yes, and both those, by the way, are, people are saying, yeah, but I compared to GDP. Well, wealth is up relative to GDP. Wealth is up relative. So really what you should do is debt to wealth, not debt to GDP. Yes, debt to GDP is definitely rising, but not debt to wealth.
All right, I have to ask one more question, Jaron. I'll let you finish everything up here. Michael asked this question, Professor. You ready? This is the two sides of the trade. What are the odds of a rate hike?
The odds of a rate hike this year is 1%. I could say 0, but in today's world, I don't know if anything has a 0 probability of happening.
So what was that?
No, I absolutely do not see. I mean, this idea of reigniting. I mean, we've lectured on this. He's doing it much less than he used to. We don't want the 1970s to 70s. I have pointed out that in the 1970s, Arthur Burns was pushing money in the system month after month. There wasn't one single month where liquidity did not, shoot up. And so to try to say that, this is like, I don't want to, prematurely ease and we're going to reignite it. The behavior of the money, which is what feeds inflation, was just 100% different. So, clearly, could there be, some sort of geopolitical event or, terrible war that cuts oil supplies and stuff like that forces, Powell to do something, always there. But it's, to me, extraordinarily small.
Jared, take it away.
Well, it's always great to get the professor's views. If you want to keep updated on how to think about asset allocation, we do have Professor Siegel branded model portfolios on a number of different platforms for people on here on our Model Adoption Center. You can see what we do. We also do a bunch of custom model portfolios for people who want to leverage our sort of CIO office and how we can help consult you on creating something custom and unique. So please stay in touch with all of those things. We do regular weekly comments from the professor. You can do us on our Behind the Markets podcast. We're going to talk about that 1995, 96, 97 scenario for tech next week with a great tech analyst. So that'll be interesting to stay in touch with our views there. But I guess thanks for everybody, and let us know how we could help as think about where you want to allocate all your assets. Thanks for dialing in, Professor. Thanks for joining us.
Thank you, Jeremy.